Hello, dear viewers. Welcome to another episode of Investology, where it is our job to deconstruct and demystify all things investing in personal finance. And today we have a special guest with us, Mr. Vetri Subramaniam from UTI Asset Management Company. Vetri, welcome to the show.
Thank you, Abhilash. Pleasure to be here. And, it's a very complex name that you have. Investology makes it seems like we are going to cover a very difficult subject, but we'll try and simplify things as much as we can. And, hopefully everybody will be able to take away some learnings from this conversation today. So, happy to be here and happy to do this.
Absolutely, entirely our pleasure, Vetri. So, dear audience, before we start, please do ask questions if you have any on the chat window. We'll try to pick up as many as possible, and if you can keep the questions relevant to the conversation today, that'll be great. I will talk a little bit about what we are going to talk about today, but before that, a small intro about Vetri. Vetri is Chief Investment Officer at UTI Asset Management Company, where he joined in 2017 as the head of Equities. Before that, Vetri was Chief Investment Officer at Invesco, where he joined in 2008, where he helped establish the firm, their proprietary investment processes, and the team. And Vetri has been in the space of equities and investing for the last 25 years. So, by all means, a veteran in this space. So, I'm really looking forward to this session. So, today we have an interesting topic on our hands. Different kinds of investment styles when it comes to investing in equities. If you're like most investors, you would not have given much of a thought about this, yet I think it is gaining a basic understanding of the investment styles. It is one of good ways to gain understanding and make sense of the thousands of investment opportunities that are available out there. Today, if you know, there are more than 5,000 different mutual fund schemes, 2,500 mutual funds, and 5,000 different schemes. So it sometimes feels like a lot. So I'm really looking forward to this session. So digging right in, Vetri, so what are the different styles of investments that are available when it comes to equity markets and equity investing?
Sure, Abhilash. So, I don't think there is a comprehensive set that I could define that there are only, three or five or seven. And I think, when you think about it from that perspective, perhaps every person or every individual, every mutual fund manager arguably has a style which is sort of unique to them. But having said that, of course, we can, start to drill it down into, some, I would say, more specific boxes. Though what we must recognize is that no manager, no investor uh, truly belongs to only one box. What I've seen over time is that they tend to have, shades from other boxes as well. So there could be a dominant thought process, but there is a array of tools that they have, and they use that array of tools to, create those portfolios. So if I were to sort of come back to your question, how many kinds of investing styles are there, at a very, very, sort of top level, I would say you can break this down into the classical styles of investing, right? So when we say styles of investing, classically we talk about growth, we talk about growth at a reasonable price, we talk about value. Value could mean intrinsic value, value could also mean relative value, or it could mean a very Graham style absolute value based approach. Then when you think through this process of thinking, picking stocks more sort of explicitly, you'll also find that there are some very seasoned investors who actually come with more of a macro overlay. So particularly when you think, not so much I would say in the mutual fund space, but some of you in this conversation today, if you've heard of people like George Soros, they were really completely macro oriented investors. So they used their macro thought processes to target certain asset classes, rather than really security selection, which means picking companies, which is what people like us as mutual fund managers do, because our asset class is already defined for us, which is equities, right? But the likes of Soros have actually made their fortunes by picking asset classes. So, that's one level of macro investing style. Finally, I would also say that, this is the reality. A lot of what we talk about in stocks or macro investing typically tends to be what I would say fundamental driven. But outside of the fundamental universe, and I'm sure some of the people in this conversation today would be familiar, I do know that there are people who look at charts to trade. There are people who look at charts through the lens of what they call waves to trade, and there are people who use trend following, which is very popular globally, as a method to invest. So there isn't really one specific definition of these are the only styles. They are large in number. People or good investors that I've seen over time tend to have shades of different styles. There may be a dominant style, but they also use an armory of those other styles when required and when the situation demands it. But hopefully this has given you some context of thinking about it more exhaustively rather than narrowly.
Absolutely, Vetri. So, but within the ambit of the different styles that we spoke about, if we are to kind of think about let's say, the 2 or 3 most dominant styles of investing that a lot of people tend to follow or they are popular, would that be growth and value investing? Is that like a right assumption?
I would tend to agree with you. In the simplest version, actually, you could perhaps break it up into you know uh, 3 different spots on a single x-axis. So at one extreme, you have what we call growth investing. At the other extreme, you have what we call value investing. Now we'll talk about it later, but the definition of what is growth and value, people may use differently. But yes, these could be put at 2 different ends of the spectrum. But equally importantly, somewhere in the middle, there is what I would call GARP, which is growth at a reasonable price, because that is actually, in my opinion, a very, very dominant sort of investing. Some people may call it GARP, some people may call it blend, but actually it's as important as the 2 styles which sort of sit at the 2 opposite ends of the spectrum.
Got that. So, very interesting. So, GARP, right, sits right at the middle of growth and value investing. But for the benefit of our audience, can we dig a little deeper into growth investing and value investing? What are these? How do you define growth investing and value investing?
So again, this very controversial topic, because each of us tends to have our own definitions of this. But I will simplify the way I have over time come to look at this difference. To my mind, particularly when you talk about growth investing, right, the focus is more about the company. It's about the quality of the business. It's about its business growth opportunity. Now, I'm not saying valuations don't play a role in the selection of stocks by growth investors, but I would say to them the quality of the business, its credentials in terms of its fundamentals, its long term growth potential, typically tend to be weighed more than what you would look at in terms of the standard valuation metrics. When you look at value investors, I think they sort of move away to the principle of saying, look, we don't want to just invest in a good company or in a good business, but the price that we pay for it is very, very important. So, of course, they are concerned with the quality of the business, but perhaps they are more willing to invest in companies knowing that these companies have cycles. So, they're not necessarily secular the way the classic growth investor is looking for companies. But the defining factor of a valuation of a value investor is that they are using some metric, a typical valuation metric, which gives them the comfort that yes, this is a company that I am willing to buy, not because it is a great company, but because it is a great stock. And what's the difference between a great company and a great stock? A great company, when it is available at a very, very attractive price, is a great stock, right? So really, one is about great companies, the other about It may be a great company, but I want to buy great stocks. And therefore, to me, the value for money equation is a little bit more important. I would say that's sort of the primary way of thinking through the differences between these two.
Got that. So, Vetri, when we think about this, right, what among these styles, what styles are more popular? I'm purely asking this question from an investor's standpoint when they are looking at it, right? If you look at the Indian, the mutual fund industry, for example, which of these styles are more popular, and how should a layman investor, a first-time investor, who is not too bothered about how fund managers pick stocks, but would like to know, would like to have an understanding of how this is done, how should they think about this? And can you kind of talk a little bit about that?
Great. So let's sort of step back for a moment, right? So we've talked about the idea of styles. Let's think about a different industry where the word style is used a lot. It's used a lot in the fashion industry and in the garment industry, right? But it's fairly predictable over there in the sense that there is typically a summer season and a summer set of colors. There is a set of garments more widely used in winter, and there is a set of colors associated with that, and then spring and so on and so forth. So when you think about fashion and garmenting, you know the colors, you know the timeliness of when the cycle typically comes. Winter could be delayed, so on and so forth, but broadly there is a consistency to it. Now the challenge when it comes to styles in the stock market is that it is not predictable, right? You do not know when a particular style chooses to come into fashion and when it chooses to go out of fashion. So I think from a larger perspective, my recommendation about how to think about styles for investors is to think about styles from the point of view of diversification. Now, why is this important? Because styles have seasons. There are periods in one's investing journey where a particular style could appear to be the secret to riches, and there could be another period of time where that same style refuses to fire. But unfortunately, it's very difficult for people to know exactly when the style will turn on and when it will turn off. Now, the danger in this as an investor is you look at the style which has done very well in terms of performance over the last 3 to 4 years, and then you start to believe that this is the only thing that matters in investing, without realizing that when the style changes or when the market season changes, equally that particular style could run into trouble. So it's not a question of which is better. We can talk later about how to identify which style might do well in different segments of the market. But really, I think the way investors should think about styles is that, is this giving me style diversification? If you look at the particular funds or fund managers who may have done very well over a particular period of time, it may not just reflect their credentials, it may reflect the fact that their style matched the mood of the market in that previous 1, 3, 5 years which you've looked at the data. But the market can change its mood, it can change its season, and then suddenly you'll find another style starting to do very, very well. So primary objective, don't get carried away by past performance. It could be a reflection of what style has done well. What you want to look for is somebody who is disciplined, who follows their style, and then diversify your portfolio by investing across styles. So the simple conclusion I would give is that market styles are a diversification device. It is not a timing device.
Got that. So the obvious next question that I have, you spoke about seasons in the market, right? So what season suits a specific style? What conditions in the market dictates that a specific style, whether growth or value or GARP, growth at a reasonable price, would do well versus the other? How do you think about that?
So let's, before we think about the when, it's also good to look at the data. And one of the good data sets that we have for this is that some of you may be aware there is a thing known as the Msci India Index. What you may not be aware of is that using certain mathematical rules and templates, the Msci India Index has two separate style constituents. One is the MSCI Growth Index, the other is the MSCI Value Index. Now, funnily enough, actually companies do not exclusively figure in only one index. There are certain companies that can figure in both, and this goes back to what I said earlier, that actually you should not think about it as one dominant style. There are shades in the marketplace. But what am I coming to? Now, when you look at the data of the MSCI Growth Index and the MSCI Value Index over long periods of time, actually what you find is that they tend to go closer towards each other. I don't mean point to point returns, right? So point to point returns is saying which index did well between 1st of December 2016 and 1st of December 2021. I mean rolling returns. Looking at the last 20 years of data, if at any point of time you looked at the 5-year rolling returns, then which style did better? The reality is that these two numbers don't look too different. There is one slight difference, which is that the volatility of the value index is slightly higher than the volatility of the growth index. So if you look at risk adjusted returns, I would have to say that it is the growth index which has actually provided better risk adjusted returns on a rolling 5-year basis, looking at the data of the past 20 years. So if you were thinking, how do I improve the chances of having my better risk adjusted returns, not absolute returns, then your choice of strategy would typically tend to be more growth oriented, because it delivers similar returns but with a lower standard deviation, which means lower volatility. However, if you started picking points in history over the last 20 years, you will find very different outcomes. So for example, if you were to pick the top of the market in all the way back in March of 2000, you will find that over the next 5 years, growth did horribly and value did very, very well. But similarly, if you were to invert and take a very different point, let's say you went to somewhere in late 2007, early 2008, value actually did terribly and growth did very well over the next 5 years. So there are different points in time in the market where one style has dominated the other style for periods of 3 years and 5 years. But once you extend to 10 years and 15 years, they tend to be similar, but risk adjusted returns are in favor of the growth style. So first of all, this may come as a surprise to people, because I find that people blindly believe that growth is the only thing that works. The Indian data itself suggests that actually both styles have worked, with a slightly superior risk adjusted return for the growth style. It's not abundantly clear that growth is the only way. If you look at the US data, Abhilash, actually you will find that it slightly moves in favor of value in terms of returns, though in terms of risk adjusted returns, it's slightly more equal. So this is really the reality of what the data sets tell you. My experience with when it is better for a particular style to be chosen as the dominant is that when aggregate market valuations tend to be very cheap, when interest rates tend to be either coming down or they are already very low, is typically the point in time where value tends to dominate growth, right? If you look at a starting point of the market, let's say in April of 2003, let's say somewhere in March of 2009, or let's say March of 2020, and you see what kind of returns you get between growth and value over the next 1 to 1.5 years. Every time value has dominated in the 1 to 1.5 year period, because starting valuations were very, very cheap, interest rates were low, the economy goes through a bit of a reflation cycle. Buying cheap valuations through a reflation cycle, you tend to make a lot more money in value. But when valuations of the market tend to be significantly above average, you've already gone through a period of reflation, interest rates are still going up or they're sort of peaking, then actually growth tends to be much superior in terms of its performance. So if March 20 was a time to sort of pick value because it had this combination of low valuations, low interest rates, and a reflation cycle, today, if I were to fast forward to December 21, I would say the advantage has actually now clearly moved in favor of growth, because you have seen a valuation re-rating in the market, inflation has started to go up, and we are at a point where the global rate cycle is starting to go up. So there is some balance in favor of growth at this point of time. But again, this is a very complex topic because there are different ways to cut it. But yeah, I mean, just based on valuations, my simple parameter, if you wake me up in the night and say, should I buy growth or value? I would say valuations are cheap, buy value. If valuations are expensive, then tilt towards growth.
Got it. There was a slight lag. Are you able to hear me now, Vetri?
I can hear you loud and clear.
Great. So thanks for that detailed explanation. Now, if you were to think about it from a layman investor's perspective, now you have the mutual fund name, what kind of theme that the mutual fund follows. How do the investors make sense of whether the style that is followed in this at this period at least is value or growth? I mean, is there any other way other than talking to the fund manager? Are there indicators to show, okay, this fund followed a more of a growth strategy than a value strategy? How do you do that?
So that's a great question, Abhilash. I can say for our fund house, which is UTI, we've certainly sort of felt very strongly about the question that you've asked, that how can an investor keep track of how we are managing our particular strategy. Secondly, how do we demonstrate that we have been consistent in terms of the positioning of the strategy? Because the last thing you want is to believe that you've purchased something which is well suited for winter, only to discover tomorrow that it's no longer a winter clothing, it's actually become a bathing suit for use in Goa, whereas you were prepared for Kashmir. So we actually publish a whole range of data. This relates to the kind of companies which have gone into the portfolio. We disclose this every month in our fact sheets. And we also disclose the portfolio price to earnings ratio, the portfolio price to book, and the portfolio return on equity for the portfolio and its own benchmark. We report this every month, and in the typical data sheets that we make available in our presentations to investors, we then show them how this data has behaved not just last month, but how it has behaved at every quarter end for the past 3 years to 5 years. Right? So that gives people a sense of the consistency with which we are actually managing the strategy. Now, this is something that we do as a fund house using our templates. But I would submit that if you look at some of the independent providers of data, I won't take their names, I don't want to be pushing one brand vis-a-vis the other, but some of the mutual fund houses and those who provide research on mutual fund, they do have their own templates based on which they make available some of this data, the portfolio price to earnings, the portfolio price to book, the large, mid, small breakup of the portfolio, and its positioning in their axis on growth, value. So they plot this data. Now, again, they typically make it available only for month-end data. But I believe that in many of these platforms, if you are a paid subscriber, you will get access to the history and you will be able to track it. It may look slightly different from the way I classify it, but the advantage is that it gives you a standardized approach to evaluate all portfolios in the market. So there are quite a few, portfolio softwares as well as these websites where in their subscription products, you would be able to track this data. But very simply, I would say P price to book is a good way for you to understand the positioning of the portfolio relative to the benchmark. What you are looking for is consistency. Do the metrics look consistent over time? And that's the way we present our data, and that's the way you will find it in these platforms.
Got that, Vetri. So at UTI Mutual Funds, obviously there are multiple fund managers, different funds. Is it that at any point of time you have a unified strategy across the board for all the funds and fund managers that this is the strategy because the market conditions are such, or it is a call that is taken by the fund manager for a specific fund?
So, great call, question that you've had over there. So let me put it this way. I think, what binds the team together at UTI Mutual Fund is our investment process. Our investment process is how we go about analyzing companies, which is the job of the research analyst, and then how we take that research and convert it into portfolios. However, the way we construct those portfolios are linked to the defined investment approach that we have for each of those strategies. So, there could be a particular fund like UTI FlexiCap, which is more about growth and quality. There is something like UTI Core Equity, which is really a relative value strategy. You have something like UTI Value Opportunities, which is more intrinsic value using a barbell approach. You have UTI Master Share, which is really a GARP style. Now, what our role and my role as CIO is to make sure that we have a dashboard of data points which tell us whether each of these fund managers is executing the portfolio as per that stated strategy. The most critical element of this is making sure that the DNA of the fund manager maps to the desired strategy. I cannot ask an individual whose DNA is growth and quality to run relative value. Neither can I ask an individual in relative value to run the growth and quality strategy. So we map the individual to a strategy which sits with their sort of personality traits, their DNA, their experiences, and then we create that dashboard and template which tells us whether everything is operating within the parameters that we described. So it's like running a car. I mean, it's most fuel efficient between 40 to 60 in this particular gear. This is the RPM. Don't accelerate too much. Don't make too many frequent changes. So we have a dashboard which keeps track of all these parameters: engine overheating, fuel level, the coolant in the engine. So we have a dashboard of all of this, and that's how we keep track of whether fund managers are running it true to their style. So one investment process binds us together, but individual strategies are very different, and they require individuals with different DNA, and we welcome that diversity in thought process.
Got that. I think that was a very interesting, take for our users. The whole idea of growth and value and GARP as strategies. Anything else in this topic that I've not asked, but you think is important for our users to know to kind of make sense of all of this better?
Yeah, 100%, Abhilash, and I'm glad you asked this question. What we are now seeing in terms of the rise is obviously the rise of passive investing, correct? Now, most of you would be familiar that when it comes to passive investing, you'd be familiar with the Nifty Index Fund, the Sensex ETF, the Nifty Next 50, right? Or the Nifty 100 Index Fund, or so on and so forth. So these are broad market indices. But really, what has happened over a period of time with passive, and we are seeing that happen in India as well, is that people have said that if this is the dominant principle based on which a particular active manager tends to run his strategies, can we extract that variable and can we create a passive strategy built around that variable? Right? So what you are seeing today is increasingly the rise of passive strategies which are built around certain variables, right? What we increasingly call as factor investing. So for example, at UTI, remember much earlier in this conversation, I talked about trend following. So we actually have a passive fund which runs on the principles of momentum investing, which is nothing but trend following, right? Now,
Right.
we are also in the process of launching a strategy which is effectively a quality, low volatility strategy. So it takes a particular set of stocks, it screens them for quality based on certain parameters, it screens them for volatility, and then creates what we call the low volatility portfolio. Similarly, we have another strategy which again we've filed for, yet to launch, which screens the mid cap universe for quality parameters, and then it creates a low cost BSE mid-cap quality index portfolio. And there are various such variants offered in the industry. Many of these are built around these factor-based investing approaches. And each of these factor-based investing approaches is an attempt to isolate a single variable and then build a strategy around it. That variable could be valuation, maybe the cheapest price to book stocks in the market. That variable could be the best free cash flow generating companies in the market. It could be companies that have got the best quality and growth criterion depending on the parameters. So who are the companies who've grown at 10% CAGR for the last 10 years, who always have a high return on equity that they've generated. So increasingly what we are seeing, Abhilash, is the rise of certain attributes that we as active fund managers have typically used now being put into a quantitative methodology where there's no scope for emotions anymore, and you put it into a passive product and you create these factor based investing approaches. So factor based investing approaches is nothing but isolation of the single variables that have gone into the thought process of active managers when we talked about styles earlier. So I believe this is really one of the great innovations in passive, and I have no doubt that this will continue to grow, because what you've effectively done with this approach is you've completely removed the scope for a fund manager emotionally making changes in his portfolio, because it follows a very disciplined set of rules on the passive side. So I think this is a very interesting development for those who are tracking style based investing.
So Vetri, I must say, at Finity, we are very, very passionate about passive investing, and especially for a lot of first-time investors who are coming into the market. Passives are a great way to get started on, and even kind of build an entire portfolio around, because you don't need to do actively go out and search for specific stocks, specific funds, and this whole factor-based investing is, I must say, very, very innovative, and we look forward to these new funds that are going to be launched. Are there any upcoming
I'm just
NFOs?
going to interrupt you there, Abhilash, to make a very simple point. When I talk
Right.
about active investing as well, I always say, look, at the core of the fund is, at the core of any investor's allocation, there needs to be diversified, broad
Absolutely.
market cap strategies. On top of that, you can put a sector, a theme, so on and so forth. I would say, even for the investors you're talking about, the young investors who are coming in, please start with the basics. What are the basics? Basics are Nifty 50, Nifty Next 50, Nifty 100, Sensex ETF. So think about this like a cake. The foundation and what gives solidity to the cake is the main part of the cake. All these smart beta factors are like the icing on top of the cake. So when you think about smart beta, factor investing, momentum, when you think about sector funds, thematic funds, we'll put some in technology companies, we'll put some in Chinese companies, so on and so forth. Those are the icing on the cake. But never lose sight of the fact that the core of your portfolio, like the core of the cake, has to have those broad diversified strategies, whether they are the Nifty or Nifty 100, or whether they are a active diversified fund. That's a separate issue. That's your choice.
Absolutely, that's a great way to look at how to construct a portfolio, and what a great way to marry active styles with passive factor-based investing and smart beta investing. Look forward to that. Amitabh Nath is asking, what is the name of the fund that you spoke about on momentum investing from UTI?
So that's the index fund that we run, which is the Nifty 200 Momentum 30 Index, which effectively screens for the top 30 momentum names based on certain rules that the NSE Indices company runs. And they rebalance that portfolio every 6 months, and we just replicate it faithfully. We launched this fund, I think, somewhere in February or March of 21, and we did a quiet launch, but we are just delighted to see the way the fund has grown. I think it's pretty soon likely to cross 1,000 crores of AUM. But yeah, this is a very popular index fund that we've been able to launch.
Can you repeat the name of the fund once again, Vetri?
Yeah. So that's the UTI Nifty 200 Momentum 30 Index Fund.
The audience, the UTI Nifty 300 Nifty 200 Momentum 30. Yeah, there you go. So Vetri, we are coming towards the fag end of our session. It was, I found it very informative, very insightful. I did learn a few things that I did not know before. we are coming towards the end of this year, right? 2020 was a very painful year for the vast majority of us. 2021 was, has been better. Economy is back on track, and we are in the midst of what many would call the greatest bull run that our stock markets have seen. So, how do you, if you reflect back on the last 1.5 years? After COVID, the markets went down by 30%, and from there on, it has been highs after highs. How do we look at this? How do you look at this whole, the market situation that we are in? Are markets overheated, in your opinion? Are we in for a minor or a major correction? What is your? How do you look at this?
Sure. Well, first of all, let me say what I believe or what my forecast is or what my prognosis is actually irrelevant, right? If there's one thing I've learned over 30 years, it is that nobody knows what the future holds. Neither did I know in Jan of 2020 that COVID would, upend all our lives. It's touched each one of us personally, not in a good way. And, the market sold off 30% on the back of that. But the last thing I would have expected, even though, we did say the market was cheap, is that it would subsequently not only recover all its losses, but go on to, unbelievable lifetime highs. So the first thing in investing we need to learn is that the future is uncertain, right? To invest on the premise that you know exactly what the future holds is to fool yourself. The only way to handle the volatility that the market inherently will have is to have a balanced asset allocation methodology in place, to frequently rebalance your portfolio, and to stay away from using leverage, because leverage or borrowing money to invest is really been ruinous to anybody who has used that strategy. I don't have any specific knowledge of what might happen in 2022. As a fund manager, I've also learned the hard way very early in my career, that trying to second guess what the market might do in the next 1 year or 2 years is a fool's game. You will never be able to consistently second guess it. My efforts over time have been focused on only one thing, which is, can we create alpha over and above what the benchmark does? Maybe the benchmark goes down 20%. Can I restrict my losses? And when the benchmark goes up, can I do better than the benchmark? So creating that alpha is our perspective, rather than trying to reduce the drawdown or to just try and maximize the upside. So don't get carried away with forecasts, including my forecast. As they say, even a broken clock, or a clock which has stopped working, will tell the time correctly twice a day, right? So just because somebody made a prescient forecast last time, don't believe that they are capable of making one again. As I said, the only things that will help you manage equity market volatility, and believe me, equity market volatility is a given. I've been in this market now for 30 years. I would be very surprised if in any 7 to 8 year period the market at one point of time doesn't lose 30, 40, 50%. I've seen it happen in the mid 90s. I saw it happen in the 2000. I saw it happen in 2007, 2008. And then of course we had this 30% fall last year. And every year, or literally I would say every 1 to 2 years, the market typically has a 10 to 15% pullback. The most important thing as an investor is not to lose sight of your objective by trying to say, oh, I want to avoid the drawdown. Too much money has been lost by investors trying to avoid a drawdown, who then fail to capture on the eventual upside. The main thing to remember about equities is that for the equity market as a whole, over longer term, the pattern tends to be in terms of creating incremental returns. So participate in that returns. Don't try to minimize volatility by jumping in and jumping out frequently. Manage that volatility by having an asset allocation which allows you to sleep comfortably at night. Most people tend to rely on mathematical formulas on asset allocation. I think those asset allocation formulas don't take into account the emotional quotient of the investor. And according to me, the only asset allocation pattern which works best for an investor is what allows him to sleep well at night. And therefore, it is completely unique to you. It can't be determined by anybody else. But of course, there are certain broad tools you need to make sure that that asset allocation gets you to your final destination.
Absolutely. So since this is one of the last sessions of the year, I'm not going to let you go away without some sort of a prediction. It will not be a prediction about the market, but what are some of these sectors that you expect? How do you look at 2022, and what are your thoughts on what are some of the trends or that we are going to see that are going to be very prominent, or some sectors that are likely to do well going forward given the current market conditions?
So, I always say this everywhere. I don't know when a particular sector will do well or when it won't, because it's very hard to say what will cause the market to change its thought process. What I am capable of is understanding where there is value and then being patient enough till the time comes for me to be able to get the benefit of a harvest, right? When it starts to do well. From that perspective, I've been reiterating this for the last few months. We see a lot of value in financials, maybe with a narrow set of companies, but we think many of the lenders in this country have come through the COVID crisis rather well. They have strong balance sheets, and if the economy is going to grow, credit will grow as well, and therefore, we'd like to stay positioned in these companies for the future. The valuations are basically, we think, quite attractive. Again, I don't want to generalize, but I think there's a handful of financial institutions that have handled this entire last 3-4 year period rather well. Two other areas of the market where we see value: one is in the whole automobile and transportation place. Why? Because how many sectors do you know in India where industry volumes in 2021 are still running 20 to 30% below the peak volumes that particular sector enjoyed in 2019? 3 years down the road, volumes are still running 20 to 25% off the highs. Yes, margins have also been crushed because companies are operating below potential, but we think the automobile sector still has a reasonably bright outlook. Because it's underpenetrated, there will be some challenges related to EV, the transition to EVs, but this is a sector where we think there is some value. And finally, the whole pharmaceutical and healthcare space, we think, is sort of mid-cycle in terms of valuation. Individually, many of these companies are significantly improving their operations. So, these are the three areas that I would highlight as sort of being interest to me as a value investor. Very different from saying what will do well in 2022. I really don't know the answer to that, because the market can be very volatile in its moods. But what I've learned is that if you identify value and you stay patient, your day in the sun will eventually come.
Absolutely. Thank you so much for that, Vetri. I really enjoyed the session. There are a few of our audience who are asking for the sessions to be held in Hindi. A couple of things here. Kashyap ji, Suraj ji, and Meena ji. So we try to kind of do a balance of both. Last week, for example, when we did the show in Hindi, there were many audience who were asking for it to be done in English because they don't understand Hindi. So we have to kind of play this the balancing effort. Also, it boils down to the comfort level of the speakers with regard to the language. But very valid feedback, and we take that feedback, and we will try to bring more and more sessions in Hindi, specifically fully in Hindi, so that it reaches a larger audience set. Feedback taken.
And we'd be delighted, Abhilash, to have one of my colleagues who's far more comfortable speaking in Hindi than I am. So we'd be delighted to have him appear on your show whenever you find it convenient, and he could, very well do it in Hindi.
Absolutely. So thank you so much, Vetri, for your time. So like I said, we will try to do some of these sessions with Vetri's colleagues in Hindi. We'll try to kind of do a balance of both, and I hope that works for everyone. Dear viewers, if you like what we are doing, please do subscribe to our channel. It helps us reach more and more audience. Am I audible? Yeah, sorry.
I can hear you.
I lost my video for a second there. Yeah, please do subscribe to the channel. It helps us, helps Google's algorithm recognize our channel as a key channel, and helps us reach more and more audience. And thank you so much for your time. Vetri, thanks once again. It's been an absolute pleasure. I enjoyed the session a lot, and look forward to having you once again on the Investology sometime in the future. Thank you so much. Have a wonderful New Year and all the very best.
Thank you, and wish all your viewers a very happy New Year.
Thank you.